Welcome to the daily update. This is Being Prepared Tuesday, August 30th, where we'll look at the action in the market today and then see how things look for Wednesday, August 31st. And before I start, I finally was able to get over the 500 subscribers on the YouTube channel. So thank you very much. And I want to welcome anybody who has not been listening to the videos for very long. And those of you that do watch the videos every day, I really want to thank you for your feedback and for your loyalty and consistency. Hopefully now, if I can stay above 500, I hope to be able to roll out some things like the community page. I know I've been talking about getting the blog back up and going. My living situation right now has not really lent it to me getting to my more powerful computer and software that I have available. And so I just haven't been able to do some of those things to this point. But thank you very much. The fact that even one person wants to watch one of my videos is very humbling to me. And I really appreciate that. And I hope that I provide something to you that is of real value. All right. That being said, let's talk about what happened. It was not a very positive day. We were hoping, possibly, if you hope the market is going to go up, that we were at some support. We saw some converging coming together at the 50-day moving average. Well, we blew right through that. Now, there's still a couple of indexes left, the Wilshire and the mid caps. They're still right around their 50-period moving average. Can we get support from that? And it would have been nicer if when we were dealing with the Dow and the NASDAQ and we were close with the S&P, but it just wasn't going to happen. So let's go back and talk about what happened at the open. We did have a lower open, which is kind of strange because during the night, the futures were up as much as 1%. Europe, which has just been getting hammered, they really rebounded on Tuesday, and that bled over into the S&P futures. But by the time we opened, it pretty much worn off. So we did have a lower open, and we immediately went right down to S1 at 4,011. And then kind of a big deal is we broke through 4,000 on our way down to S2, which was at 39.91. Didn't see really any kind of a significant bounce. Any rebound attempts, they were met with resistance as they tried to come back up to S2. We never made it down to S3, but we couldn't get back above S2 at 39.91 again. There just wasn't the buying enthusiasm to do that. We did close a little bit off the lows, so that's a bit encouraging, but we still ended up being down 1.10%, and volume continues to be below average. So when you look at everything, our technicals, yeah, they're negative. There's really not a lot to suggest that we're positive right now. And if you know me, when we're going down, I'm looking for reasons why we could go up. If we're really going up, I'm looking for reasons why we could go down. And there are some positive areas that I'll point out, especially with the Wilshire and with the mid caps. But things are pretty decidedly negative right now. And another thing that's kind of concerning is sentiment is right about neutral. So from a fear aspect, we still could go a lot further before people really start to freak out based on the indexes that we use. Of course, inflation, interest rates, growth concerns, that's the big issue. Last Friday, when Fed Chair Powell spoke, that really spooked the markets. And there had been this scenario that maybe inflation had topped out, was going to start coming down. We were seeing that in the economic reports. And so perhaps maybe the Fed could back off a little bit and start to lower interest rates at some point in the future. Well, when he made that speech, that blew all of that right out of the water. And it's kind of switched the whole scene right now for any kind of real positive attempt. We might need to fall more to freak more people out before we can get set to go up. But we are at different areas of support, so you never know. Sometimes some buyers could come in, especially later in the day, the last 1 to 2 hours. That's when the professionals come in and really take over. That's why I really focus on that part of the trading day. And we could see some kind of bounce, and we're not necessarily oversold with many of our indicators right now. There's a few, but I'll go through them. So getting back to this, we do have the whole list of geopolitical events. It's inflation, it's the Fed, which is kind of strange because really the Fed is supposed to follow what the market does. Well, we've seen a real switch in that now, and everybody is hanging on every word that especially Fed Chair Powell says. And if they don't like what he says, we go down. If they do like what he says, he goes up. Now, it's always been that way to a degree, but usually the market anticipates these things, and then the Fed ends up confirming what the market already wanted to do. Well, we've been spooked out a couple of times now this year where it looked like the market was telling the Fed one thing only to have the Fed say, no, we're not going to do it that way. And that has produced a lot of the choppiness that we've seen in 2022. All right, what are some comments? Selling continued as support was broken. We did go below 4,000 in the S&P with the mid caps and the Wilshire. They're still above support, and I'll show you those charts. All of our scenarios, even though they're viable, they're still on hold right now. And what might happen is that at some point we go down and generate new signals if this thing really starts to fall. Because are we going to go down back to the June lows? Are we looking at that much of a decline? We have to at least think about that for right now. The 10 to the 2 and the 10 to the 5, they're still inverted as far as their yield curves. And we still are seeing a pretty strong inverse correlation between interest rates, the dollar, oil, and stocks, even though they're jockeying around a little bit. Sentiment, this is kind of the concern. We're falling, but people aren't really freaking out right now. And we did have consumer confidence that came out. It actually rose. It must be because the Mariners are having a pretty good season. Yeah, that's it. At 103.2, they expected it to be at 97.4. Okay, what does that mean? Well, this is the first increase that we've seen in 4 months. And just to compare this to what it was a year ago, and a year ago wasn't all hunky-dory all the time, but we were at 115.2 at that time. The job openings came out, and we still have a lot of jobs out there, almost 11.25 million jobs available. Now, this doesn't tell us the quality of the jobs or anything like that, but there are jobs to be had. The housing price index actually rose a little bit. We've been seeing that decline overall. It was up 0.1%. And the S&P Case-Shiller Home Price Index, it rose 18.6%. They expected it to be up 19%. That's still pretty high. That means housing prices, at least according to this, are still going higher and higher. Our trend, it is negative with the red line on top, but it is weakening because the ADX is declining. Our bias is negative with the down day, and the last number of days have been negative, so our momentum is also negative. Let's go back and look at the session. We are right at about the midpoint as far as fear and greed. This could be a little bit concerning. We want to see it way over in the extreme fear category to produce some kind of capitulation that makes folks say, forget it. I don't want anything to do with this. Well, that's the time when the smart money comes in and they really start buying with a vengeance, and we hit a bottom and start going up. We're not freaked out enough right now. And here's the historical chart. Here are some Isabel net charts. This is just showing the correlation between Apple stock and job openings. As there are more and more jobs available for folks, Apple has had its, excuse me. Don't you love these unedited videos? And background noise, that's being provided to you at no additional charge by the country drill boys as construction continues to go on. All right, getting back to this chart, we tend to see Apple and job openings go hand in hand with each other, but they're starting to disconnect as we're seeing job openings drop off. Even though there's still a lot, Apple has been going up, but yet falling back. Are they going to get back closer in line with each other? This also is just the projection now from Goldman Sachs. What do they think rates are going to be as 2022 goes on, 2023, and then into 2024? Compared to the futures market, they're not all that far off of each other. This is kind of interesting. And if you've been watching the videos for a while, you know that I don't really rely on these kinds of charts all that much. You could have, this is saying what are the monthly returns going back to 1985. Okay, fine. let's say 90% of the time in a current month, the market goes up. Well, that's all fine and dandy, but there's still 10% of the time when it doesn't. And so we still have to focus on whether it's going up or down. We can't always just go with these kind of broad statistics this way. We can look at this and say, okay, in September, we typically have a weak month. I know a lot of people think October, because that's when we usually have had our major crashes over the last few hundred years. But September is typically a weaker month for the market. I wouldn't necessarily use that to make decisions, just something to be aware of. But yet, if you've lived through 2022 so far, we've had a pretty weak year overall. Just about the time it looks like things are getting better, we stall out and start going back down. This is just taking housing prices over on the left. This is what's actually been reported with the light blue over on the right. These are forecasts, and they're just projecting that prices are going to remain flat. This is the technical overbought, oversold composite. We had come up kind of nicely and came not quite to an extreme positive reading, but now with the declines, we're really starting to drop down and we're at 48.58. 50 is kind of the defining line here. So we're just going slightly negative. Now, with the declines that we have been seeing, this will probably drop even more. This is kind of a confusing chart because this is interest rates. The purple line is tips, and they adjust for inflation. And so we should really flip this around. When it's going down, that means interest rates are actually going up. And this just shows us that there is a pretty strong inverse relationship between interest rates going up and the NASDAQ 100 going down. And that's what I show in the intermarket analysis videos that I put out, is a lot of these different relationships with each other, a lot of the correlation charts that I show. So we pretty much look at this every day and at least every week. This chart is also suggesting that earnings per share, they're starting to come down overall. The revisions are coming down and the year over year is also declining. And that's ultimately what justifies the price of a stock. If earnings are going up, that justifies a higher price. If earnings are going down, that justifies a lower price. Well, overall, we're starting to see these earnings coming down. And that's ultimately probably one of the biggest headwind that in longer term that the market really has to contend with. All right, this is what happened on Tuesday. Every area was negative, with growth being down just a little bit less in the large caps, a little bit more in the mid caps, and a little bit less with the small caps. The VIX, it went actually a little bit sideways on a closing basis, and we did close a bit up off of the bar. That little bit of bounce that we saw near the end of the day could have helped this slightly. And the VIX of the VIX also didn't really change all that much for having a down more than 1% day. The Ulcer Index, it's starting to go up, and I'm just using the daily chart now because this is really kind of what we should be seeing as far as sentiment. This measures fear, and we came above the moving average, and it's starting to climb as we are going lower. We're down 17.28% from the all-time high. We did climb with the 1 day chart of the equity put call ratio, and we continue to climb with the 5-day chart. Here are the pivot levels for Wednesday's session. If you want to pause this, and hopefully you can see these numbers. If you ever want to get these numbers from me, first of all, there's a link I can send you to a calculator that you can use to calculate them yourself, or just let me know, and I could make this available to you if you want to know these numbers. This is what I follow during the day, is a 10-minute candlestick chart of the S&P 500. Here's the daily chart showing how we're right about average, a little bit below with volume, but we came down, and this is what we were hoping to stay above, this blue 50-period moving average. We went down below that. There was some hope that maybe as the day got closer to the end that we might be able to come back above that, because there's probably an awful lot of stop loss orders that got triggered because we also dropped below a pivot level. So the fact that we didn't come back and close above the pivot or the 50-period moving average, and we went under 4,000, you take all those together, and that's pretty negative. Here are the pivot points for the month, showing how we were really on the edge after Monday's session, well, we've now dropped down, and we're actually dropping down below the fib retracement level. That's the green one here. Not retracement level, pivot level. Here are some fib levels that I do measure, going from the high in March to the low in June. We came all the way up and retraced rather nicely, but we've been breaking down now. Here's another shorter term chart, just going back from the low in June to the high that we set. I'm sorry, the low in June to the high that we set in August, and how we've been now retracing down from that. And we've retraced more than, well, we're right at about the 50% of what we retraced from the June low. Here's a more intermediate term. This goes back to the all-time high, to the low set in June. We came up and we're going above the 50% retracement, but have since been breaking down. Here's a little bit longer look, going back to the low set in 2021, where we've also been breaking down now. And this goes back to the COVID low, to the all-time high, and it has a couple of fib levels that are overlapping each other. We're starting to break below what was a good solid 50% retracement level here. So there's a lot of technical damages being done. The market had a chance to recover, and it's just not doing that. All right, let's look at the different sectors. All the sectors were down, with energy being down the most and financials being down the least in Tuesday's session here. And I actually tried to sort it the right way this time. Energy, utilities, and staples. These are the value plays. They tend to be the strongest from a technical analysis standpoint. Here's just showing how energy is still doing the best, even though it had given up a lot. It's getting a lot of that back as the year goes on. Utilities remain positive, but all of the other sectors are still down since the all-time high in January. This also goes back to the all-time high in January, showing how the different indexes have done, with the Dow holding up the best, the NASDAQ and the NASDAQ 100 holding up the least. Technical alerts, negative across the board. There's the one for the S&P is that we drop below 4,000. A lot of different sectors have now crossed the negative. We had the NASDAQ just falling all over. Oil actually went down, which could be seen as more positive from a consumer standpoint, but nothing really positive generated as far as our technical alerts. Here's our scores. We have the Dow back in first place at 63.9, which is still a pathetic score, but it's holding up the best, followed by the mid caps at 61.2. This S&P, it's dropped under 50 now. So that's a little bit more negative as far as its scooter rank at 48.4. We have small caps, which had been doing better. They're now down at 47, and taking up the rear and dropping even more are the Qs, which is the NASDAQ 100. They are currently at 23. So technically, we're not looking real pretty right now. Here's the intraday chart. We had been up during the night, and it looked like we might get a positive open. Nope, that quickly vanished, and we went all the way down below S1, all the way down below S2. We set some kind of a low here. It might have been in some other index, but I couldn't really, at least just spotting this, wonder why did we stop right here? Why was this the low? It wasn't necessarily a round number, and we just chopped sideways. We tried to go back up, but we could never get back above S2 with any real conviction, and then we closed slightly off of the worst levels of the day, slightly below. Our trend, we have the red line on top and it's advancing. The ADX is declining and underneath the moving average. So we are in a weakening negative trend. Now, if this continues, this ADX is going to start to turn up and go above the moving average, and it could turn into a stronger trend, because what it had been measuring is a positive trend. And when we switch from positive to negative, the ADX will take some time to weaken, just because it's measuring the red and the green line together. The Arun's not helping us right now, so I'm just going to skip over that one. We're seeing some weakness with the advanced decline line based on price and volume. The advanced decline ratio continues to show weakness. New highs, new lows, also weakness. Some short-term looks. The rate of change going back 10 days, we're starting to get a little extreme, but we could fall a lot further from where we're at right now. Here's our moving average tree where we're starting to drop below all of the moving averages that I plot here. Stochc RSI, extreme negative. Williams percent R, extreme negative. Force index, you could say extreme negative. We're still kind of on the outside of this Keltner band right here. This is something that I pointed out in yesterday's video that could have been positive. Well, it didn't really help us that much. And the Swinland trading oscillator is now starting to decline based on price and volume. McClellan oscillator, negative and starting to get extreme. Our moving average studies, the 20 is starting to get extreme negative, but we're still seeing declines with the 50 and 200. Stochastic, short term, extreme negative, intermediate term, extreme negative, but the long term is still in a decline. We're down below the 50-period moving averages. This was a point of hope that we might have been looking at. And the red line here, which is the simple moving average for the 50 period, that's a big moving average. And we not only broke below it, but closed below it. The Sean trend meter continues to show weakness. The PMO, weak. The PMOs that are rising, starting to get extreme negative, as are the buy signals, and we're rolling over with those PMOs that are above zero inside the S&P 500. Chaikin oscillator, negative. Chaikin money flow, negative. We saw a little bit of a pickup in volume, but we're still well below average. The vortex, negative. Summation index based on price and volume, declining. All of our oscillators are declining. BPI, declining. Ease of movement, declining. Ultimate oscillator, declining and not necessarily extreme, as is the money flow index. The CCI 14 period starting to get extreme negative, as is the 20. And the TTM squeeze, it's now in a lighter shade of red, and that is starting to turn more negative. And this red moving average here, this is an anchored moving average, which goes all the way back to the COVID low. So this kind of separates where have we been since that COVID low. We're starting to drop below that now. Here's one that I haven't shown in a while. It's the balance of power. When we drop below this dash line, that's negative. So the balance of power is now switching over negative. Our Heiken Ashi chart, yep, looking more negative with the solid black candles. The Kegi is turning negative with the red. The Renko chart added another red box. That's negative. Three-line break is negative. We added another zero with the point and figure chart. And it looks like we're starting to break down with that chart as well. Our Elder Impulse with the S&P is negative, as it is with the SPY. The SAR continues to be negative with the dots on top. And we switched over to red with the go, no-go system. That's negative as well. The 100-period moving average. Also, we were kind of hoping this might provide something. It did provide a little resistance. Well, we've broken down below that now as well. And our rainbow, we're, after being at the top of the rainbow, now we're in danger of falling out of the bottom of the rainbow. All of our moving averages on the longer term are declining. And our special K, which slowly had been trying to show a bit of a recovery, is now rolling over with the decline. The diamonds are negative. That's the Dow ETF, and the Dow itself. This was a point of hope yesterday where we were above the pivot and we were above the moving average. Well, we broke through that. And here's the Qs, which are negative. This also had been a point of hope, but that was shattered in Tuesday's session. The Vixen itself didn't really advance all that much for the volatility on the NASDAQ 100. Here, this could be seen as a little bit positive with the NASDAQ. We're just about at the pivot level, but we're below the moving average. So that we were looking at this to provide support, and it did not do that. The mid caps, we're still above the moving average. This is a small little glimmer of hope here. We're above the pivot, and so we still have a little room, but is that enough to give us some kind of support? And the Wilshire, Also, even though it closed down below the moving average, it closed just slightly above the pivot level. I'm really having to hunt right now for positive things. The dollar was down just slightly, but still is in a really strong uptrend. Here's the correlation between the S&P and the dollar. They're still fairly negative. The dollar was actually down for a lot of the day as the S&P was down as well. That's why this curled up slightly. Gold, and again, you would think gold would just shoot to the moon, but it's not. It continues its decline, as does silver. Oil actually came down a little bit. You would think that might provide a little bit of support. We're down to 91.68, but it didn't. Here's the correlation between the S&P and oil. They were both down in Tuesday's session, so this turned up slightly. Bonds, again, we're not really getting a lot of love or help from bonds. They were up slightly based on price, but our world bond index is still going back to this low that was set not so long ago. The stock to bond correlation, it's getting a little bit stronger. And again, as I say, to turn things more positive, we want to see stocks going up and bond prices going up, which can bring interest rates down. That would turn things more positive. The fact that they're both going down, this is not really the positive or strong relationship that we really want to see if you're more bullish on the market. We still have the 10 to the 5 that's inverted and the 10 to the 2, and we're keeping an eye on the 10 to the 3 month, which is still just hanging in there. The tech sector to the 10-year yield, also, they both declined a little bit, so that turned up slightly. Here are the yields. You had a longer term yields going up, more intermediate term yields coming down slightly. And our scenarios, I just kind of have to briefly go through them just to show you we're not really focusing on these right now because they're just not giving us much to go with. But if we do see some confirmation in price, then we'll start to focus on this. Small caps also could be giving us some hope here. We're right at about the moving average, even though a little bit below it, and we're right on the pivot. And I didn't add that to my list, where we're pretty much going sideways with the small cap ratio to the S&P, so we're not really getting any signals from that. The S&P to the 10-year also having a really strong inverse relationship. And our sector rotation, it's showing some weakness with the Qs, discretionary, growth versus value, and large, mid, and small caps also showing some declines. Doesn't mean they're gone forever. They're just not being used right now. And we're looking at the 2-year yield versus the S&P 500. They're tending to go in opposite directions, which takes this scenario off the table because we're probably getting ready to take out that recent spike that we've been using. The staples, they were down as well. So this is still holding up, but compared to the S&P, this ratio is starting to go back up. Now, we're not really close to this spike that we're using, but we really want to see this decline, and we want to see prices in the S&P to go up for this to be a viable signal. All right, so what's our outlook then? The technicals are negative, and they're losing support. We have mortgage applications coming out and the AD employment change. That's ahead of the big employment situation report coming out on Friday. We have the Chicago PMI coming out, the whole list of geopolitical events with inflation and interest rates being the real concern. So what are our scenarios? We have to go with the down scenario right now. Everything is really looking negative across the board, especially the technicals and the fact that we could not hold up through support. What could help us go up? Well, some of this kind of outlier type support that I alluded to, that might help us. Some real positive news that comes into the market could help things. Maybe Chair Powell sends a cake to the New York Stock Exchange. I don't know, but all of our different scenarios, they're on hold for right now. Our technicals, you can't really rely on those because we're giving up our moving averages and our oscillators are negative and we're blowing through support. And you can't really say that we're sideways right now because the ADX is still above 20 and it is negative. So our conclusion, we just have to say everything is negative right now, which sometimes can be a signal in and of itself. When everything is positive, oftentimes that means the top. When everything is negative, that often means the bottom. The thing that concerns me is sentiment. People aren't freaked out enough. And so that means that there still might be more room to go to the downside. Not necessarily right away. We might see some kind of bounce here and there, but overall, we're still pretty negative. So thank you. Have a wonderful day, and I'll look at preparing a full-blown video after Wednesday's session if we see something that looks significant. If it's just a boring chop sideways day, I may just do a brief video.